We watch a lot of tech stocks, and it's not often that you'll see a stock fall over 60% after earnings. So the reason you're watching this presentation is probably because you fall under two categories of people. We turn to the Ministry of Truth here, take a look at what people are looking for. So the common searches are, why is desktop metal dropping or down? And is desktop metal a buy or a good buy? So you're either somebody that's holding shares and you're really concerned that you might be becoming a bag holder, or you're somebody that's saying, wow, this is an interesting company and there may be an opportunity here. So let's start by talking about something called the efficient market hypothesis. They teach you this in B school, and it's about the fact that all the information that's available is priced into the market. And when new information becomes available, the market adjusts accordingly. So we'll give you an example here. This is the stock price chart for Desktop Metal. Now, when this firm had their SPAC, we had purchased some shares, and that was right around the $10 mark. So when shares doubled in very little time, we attributed that to hype and started to exit some of our position. And then that's the top blue line that you see there. And then we finished exiting our position at the bottom blue line because we adopted some new rules around SPACs. We've covered over 90 different SPACs, and we're only holding one in our portfolio right now, and it's not Desktop Metal. So the efficient market hypothesis on the upside tells you that if a stock price moves up sharply and there's no new information, that's probably hype. Similar on the downside, if a stock price falls sharply and there's no new information, then it's probably hype. And there's been a lot of volatility around 3D printing stocks. We want to be careful about whether or not this downward move of 60% is related to information or just hype and speculative trading. Now, what happened to Desktop Metal? Well, we have three pieces of new information in the SEC filings. There's this press release about a convertible notes offering. There's the Q1 2022 earnings. And then they also provided this unaudited pro forma exhibit of X1 financials. So as a result of that, the stock closed down 61%. That was the result of yesterday's trading. And when you look after hours, it's up 18%. So there's a lot of volatility there. And we don't like volatility. Volatility equals risk. So as we said earlier, two types of people reading this would be either people who want to make sure they're not holding a stock that goes to zero, and other people are saying, well, maybe there's some value to be had here. So that's what we want to try to look at today is what was the information made available that can explain what happened. Now, we wrote about Desktop Metal back in November of 2021. We've probably written 5 or 6 articles about this company, and I'll put a number of them in the description of this video. And we made a few comments, one concerning how much money they're blowing through. So we said if they're blowing through $250 million every year, they're going to need to raise more money to survive, whether that's equity funding, which would dilute existing shareholders, or debt funding, which comes with its own risks. And we said they may have access to deep pockets now, but what happens when all that easy funding dries up? Well, I think we're seeing the purse strings tighten when it comes to funding. Now, when we look at the Q1 2022 financials, there's just real simple numbers that we want to look at here. So first, there was a comment from the company that said their operating expenses were higher than planned. Now, this is after that they said the last time we checked in, they talked about a focus on profitability. So they're making sure they bring this out. They say it's higher than planned, and this was associated with Q1 product launches of the production system P50 and Einstein series. Well, these production systems that are expected to generate all this revenue are costing a lot of money. And at some point, we want to see those revenues start coming in. You'll see that analysts in their earnings call are becoming increasingly concerned about seeing those revenues. Now, if we extrapolate this $69.5 million loss, or say annualize that, multiply it by 4, that's $278 million that they'd burn through if they keep going at that rate versus the $155 million last year for operating expenses throughout the entire year. So you can see that they're starting off on the wrong foot here when it comes to losses. And the other thing to note is that look at their revenue. So we'll talk about that number in a bit, but look how the margin between total revenues and total cost of sales is negative. So if your cost of sales is more than what you're selling, at what point do you hope to make a profit, even if you removed all your operating expenses? So that has to be a concern, seeing that pathway to profitability. What we would look for would be a high margin consumables stream that would help boost those margins. And as we've said before, we don't see them breaking out any more granularity than what you see here, which is products and services when it comes to how they're telling us how the firm makes money. Now, let's talk a bit about the notes. What's the worst problem here is that they really didn't tell us anything. So they ended the quarter with $206 million. Okay, so that's the cash and cash equivalents. And then they told us, well, we're going to raise 150 million more using these convertible senior notes due 2027. And then there's an option for an additional 22.5 million. So let's say that's 72.5 million. Okay, but this bottom point here, this is critically important. It says the interest rate, initial conversion rate, so they can be converted to equity, and there's dilution if that happens, and other terms of the notes will be determined at the pricing of the offering. Well, that kind of sucks because now we don't really know anything. There's some real uncertainty in the air. So that certainly has to have contributed to the downside that we see in the share price. Now, when it comes to revenue guidance, this is something else that we found a bit odd. So if you look at the two green bars in this chart, so you see Q4 2021, that was last quarter. And then we have this most recent quarter. Well, that's a problem that it's down, but they attribute that to seasonality and a number of other reasons that they give in the earnings call. But when they talk about their forward-looking guidance, which is $260 million for the remainder of the year, they say, and you can pause this if you need time to read what they actually said here, but they're expecting that Q2 and Q3 to be in the low 20s in terms of percentage of that 260. And we've just guesstimated that out here. And then it says, they make this weird comment, Q3 tends to be down given the European shutdown. Not sure what that refers to, but then they say that the balance of the revenue will be in Q4. So we're going to be waiting the entire year for this giant quarter. And then they say that this is a similar pattern to what we saw last year. Well, last year, you're making acquisitions. That had nothing to do with this year in terms of the reasoning for this pattern. So that's an odd statement to make. And what in essence they're doing here is trying to take all this optimism and say that eventually we're going to get there in terms of our guidance and the new machines we're selling, in particular the P50, which we've expressed some concerns about before in terms of their ability to commercialize that machine. But here's another thing to consider as well. The purchase of X1, so we remarked that there was a lot of goodwill involved in that purchase. And this is what we said here at the bottom. We're having a hard time understanding why such a premium was paid when the company hasn't been able to grow their way out of a wet paper bag. You could see here that the growth of X1 has been stagnant. So this was their biggest acquisition. If they acquired a stagnant firm, then how can you expect revenues to suddenly start growing? And I think it's the release of their new products, the P50 and the Einstein, that they're expecting will generate a great deal of growth. Now, in the earnings call, there's some interesting things there. And what we usually do is just take the transcript. This is a transcript taken from Seeking Alpha, actually transcribes these, and the Fool does as well. But there were some questions in here that were interesting. The first one relating to the P50. And this individual says, can you maybe give us an update on customer engagement activities in the pipeline, early customer feedback, if you're comfortable, share it. And the answer says nothing except, I mean, there's a longer answer to this, but the sentence we pulled out is, I don't know if every customer will let us talk about a program the way that Stanley has, because usually this goes to very large companies. Well, Stanley hasn't really said anything. So if that's the extent to which a customer is talking, then what have we really learned in this earnings call or otherwise about the success that Stanley is having? We talked to their CTO back in 2019, and he told us that they had deployed two machines, one to a Fortune 500 customer and another, I can't recall, maybe to an Indian firm. So they were deploying these machines back in 2019, and then Stanley was their first customer. Well, what we attribute that to is perhaps the first iteration of this machine wasn't up to snuff. And you can look back at the research pieces that we've done where we specifically talk about this and conversations their management team has had around this. So I'll put those in the description of this video. And then the second question here, certain products you want to highlight that contributed to that increase in inventory. So I put this in there because it was kind of interesting. The analysts seem to be concerned about this increase in inventory, perhaps implying that, build it and they will come. Well, they built it and nobody's coming to buy it. And then they talk about how, say, Desktop Metal talks about how roughly 2/3 of the increase in inventories is finished goods that actually got cut off. So that was an interesting remark to make. So they have a lot of finished goods, and presumably they're not able to sell them because of supply chain issues or whatnot. But and then the last bullet point here, it says, on the convertible you guys announced today, this is a good point. It says, if you guys do 260 million in revenue and have this massive ramp at the end of the year, so correctly calling that out, and this hopefully sentiment would be better than 2, why now, I guess is the question. So this analyst is making a good point. If they have enough cash to get through the year, why don't they do this convertible notes when things are looking better and they have a better seat at the negotiating table? And then, of course, the answer from Desktop Metal is we can't comment on raising money for regulatory reasons. So there you go. Other concerns. So the market cap of this company is now $416 million. We refer to companies under $1 billion market cap as being in the death zone. That means we don't invest in firms with a market cap of less than $1 billion. There's also a concern around delisting. So if they trade under $1 for 30 consecutive days, that's just one example of rules that might result in a delisting. And of course, this extreme volatility. So as they teach you in B school, volatility equals risk. So the higher the volatility, the more risk. And we're risk averse tech investors. We don't like volatile shares. So just to conclude, I'm going to go back to the last article that we wrote about Desktop Metal, which wasn't very long ago. And here are the conclusions that we reached, and they haven't changed. First of all, we need more color around the success or failure of their flagship product that the entire company was built around, the P50. We need more color. We need to see revenues start flowing for that. We need to see a breakdown of revenues by type. So they made all these acquisitions, something like 10 acquisitions. They're detailed in our recent research piece. And we need to see those broken out in terms of contribution. So they have this new segment, Desktop Health and Desktop Labs. Well, we'd like to see where the revenues are coming from. There's a lot of moving parts that have been put together, and we need to see what that looks like afterwards. And that also refers to synergies and things like that, and relates to this last statement that we need to see a consolidation and complete audit of all acquired companies. So they need to go through and find out where all the dead bodies are buried. And I don't know how much time that might take, but you can imagine that they're still digesting what they've acquired. So perhaps another quarter or two, and maybe they'll have been able to digest all that and put it together, and we could feel more comfortable about what they've acquired and what it looks like. And then as we get to the end of the year, we're expecting this monster quarter. So please put your comments in the comment section. We'll address them there. Make sure to subscribe to our channel. And thank you so much for taking the time to watch this video today.